Imagine running a business where your physical inventory is, just flying off the shelves faster than it has in years.
Right.
You've optimized your pricing, you're clearing out your stale products, and your operational efficiency is genuinely breaking company records.
Sounds like a dream scenario.
It does, right. But then you sit down with your accountant at the end of the quarter, and they just slide a piece of paper across the desk telling you that you lost $173 million.
Ouch. Yeah.
I mean, how is that mathematically possible? Welcome to the Deep Dive. Our mission today is to look past some incredibly dense corporate jargon. We are trying to reconcile two totally different realities presented in our source material.
Yeah, we are looking for the truth hidden right between a triumphant operational narrative and a bleeding financial spreadsheet.
Exactly.
So we are dissecting the Q1 2026 earnings script and the financial data for the real estate giant Opendoor. And that paradox you just described, it's the defining feature of this entire report.
It's wild.
It really is. It is the absolute definition of diagnostic muddy waters. I mean, when you read the updates from the teams actually buying and selling the houses, it sounds like a victory lap.
Yeah, they sound thrilled.
Right. But when you look at the DAP accounting, the generally accepted accounting principles, you would swear you were looking at a company fighting for its life.
Okay, let's unpack this, because before we even touch the complicated accounting and the balance sheets, I insist we look at the physical houses on the ground.
I agree.
We have to flip the script. Think of it like trying to evaluate a massive retail chain.
Okay.
If you want to know if that store is thriving, you don't immediately lock yourself in the back office to read tax filings.
Okay, of course not. You'd walk the floor.
Exactly. You look at the shelves, and for Opendoor, their shelves are residential neighborhoods across the country, and their inventory is actual houses.
Right.
And looking at the operational data, the numbers are honestly staggering.
They really are. They paint a picture of a machine that has been completely recalibrated. Let's look at their primary management objective for the quarter, which was, quote, scale acquisitions.
Yeah.
In Q1 2026, their acquisition contracts exceeded 5,000 homes.
Which is, wait, that's double the figure they posted just one quarter prior,
Yeah.
right? In Q4 2025.
Exactly, double.
Wow.
Yeah.
And home purchases actually jumped 45% quarter over quarter. I mean, they were turning the faucet back on at a blistering pace.
They are. But, the volume of purchases isn't actually the most impressive part of the physical operation.
Oh, really?
Yeah, I mean, buying houses is easy if you have a big enough checkbook.
Sure.
The critical metric for a company like this is velocity, how fast they are getting those houses back off their books. And that brings us to the most vital operational data point in the entire report.
Aged inventory.
Aged inventory.
We really need to pause on this because this stat just stopped me in my tracks. For anyone listening who isn't steeped in property management, aged inventory refers to real estate that has been sitting on the market for over 120 days.
Right.
Now, a lot of people think of unsold houses like, I don't know, milk going bad in a grocery store.
Mm-hmm.
But that's not quite right. A house doesn't just rot in 120 days.
No, it doesn't.
Holding a house is more like leaving the meter running in a taxi while you run inside a shopping mall.
That is a great analogy.
Right, because the house itself is physically fine,
Mm-hmm.
but the carrying costs, the high interest rates, the property taxes, neighborhood HOA fees, the maintenance, all of it is ticking up every single second.
Yeah, eating your profit margin alive.
Exactly.
That is the perfect way to visualize it. Holding costs are the silent killer of institutional real estate. And if you go back to Q3 of 2025, a highly dangerous 51% of Opendoor's inventory was aged.
51%. That is terrifying.
Yeah, more than half of their houses were just sitting there with the taximeter running.
But look at what happens when we fast forward to this new report. By Q1 2026, that aged inventory number plummeted down to just 10%.
10%.
Yeah. And for context, the broader real estate market average right now is sitting at 33%.
What's fascinating here is why this matters so much and, how they actually achieved it. Dropping your stale inventory to 10% while the rest of the market is stuck in the mud at 33%, that isn't just a stroke of good luck.
No, definitely not.
It signals a deliberate algorithmic shift in how the company operates. I mean, normal human sellers are emotional.
Oh, heavily emotional.
Right. If a human buys a house for $300,000, they will refuse to sell it for $290,000, even if the market has cooled. They will let the house sit for 6 months waiting for their price.
They can't take the hit to their pride.
Exactly. Opendoor's algorithm, however, removes the human ego. They realize that taking a swift, small loss to clear capital is vastly superior to paying those crushing, ticking taximeter holding costs for an entire year.
So they essentially used their data advantage to aggressively price homes to clear liberating their capital.
Yay.
The sources point out that the recent groups of homes, specifically the cohorts acquired in Q4 2025 and January 2026, they're behaving completely differently than their older inventory.
Yeah, much healthier.
The management team explicitly calls these the best cash acquisition cohorts in the company's history, Right. excluding the weird zero interest rate anomaly of the COVID era.
Sure, of course.
Yeah.
But they are buying better, they're pricing more realistically, and turning the inventory faster. Because of this newfound velocity, they've achieved the highest resale contribution margin in nearly 2 years.
Wow.
And management is leaning heavily on this physical momentum to signal to Wall Street that they will be EBITDA profitable on a 12-month forward basis.
Okay, so the houses are moving, the algorithm is behaving rationally, the operational engine is just humming.
Yes.
But this is where we run straight into the spreadsheet shock.
Here we go.
Because if you have thousands of houses moving at record speed with great margins on these new cohorts, why do the headline financial numbers look like an absolute disaster?
Yeah.
I have to push back on this narrative of a triumphant turnaround. If they are operating better than ever, why did Q1 2026 revenue drop by $433 million year over year?
A huge drop.
Top-line revenue is down to $720 million. And even worse, the net loss widened year over year by $88 million to hit a $173 million hole.
Yeah.
That doesn't sound like a structural shift towards success. That sounds like a company bleeding out.
I know, it looks catastrophic on the surface. But to untangle this, we have to understand the specific mechanical friction of real estate accounting. Specifically, the concept of lag. Real estate is not an instant transaction. I mean, if you want to buy a share of stock, you click a button and it is yours in milliseconds.
Right, instant liquidity.
Exactly. But if you want to buy a house, you have to find it, negotiate a contract, schedule an inspection, wait for title clearance, close the transaction, renovate the property, stage it, list it, find a buyer, and go through the entire closing process all over again.
So it's an asset weighed down by massive physical and legal friction.
Precisely. Because of that friction, a year-over-year revenue drop reported in Q1 2026, it doesn't tell us anything about what Opendoor's algorithm is acquiring today.
Oh, I see.
Yeah, that revenue drop is a trailing indicator. It reflects the severe slowdown in their buying strategy that happened 6 to 9 months ago when, interest rates were completely unpredictable.
Right.
If we want to see the real story of the current business, we cannot look at the trailing year-over-year numbers. We have to look sequentially. We need to look at how Q1 2026 compares to the quarter immediately preceding it, Q4 2025.
So we judge them on their immediate past, not a ghost of the market from a year ago.
Exactly. And when you look sequentially, the trajectory changes entirely. In Q4 2025, Opendoor reported a colossal net loss of $1.096 billion.
Billion, with a B.
Yes. But fast forward just 3 months to Q1 2026, and that net loss shrank dramatically down to $173 million.
Okay, wow. Going from $1 billion crater to a $173 million hole is a massive swing.
It is.
It's obvious still a loss, but the trajectory is violently upward.
And if we dig into the specific profitability metrics sequentially, the underlying health of the transactions becomes much clearer. I mean, the gross margin actually improved from 7.7% in Q4 up to 10% in Q1.
Okay.
Even more telling, their adjusted EBITDA loss narrowed from $43 million down to $31 million.
Let's make sure we ground those terms for the listener just real quick. Adjusted EBITDA is basically Wall Street's way of looking at the core profitability of the day-to-day operations by stripping out taxes, interest, and certain non-cash accounting expenses.
Right.
It is management's way of saying, hey, if you ignore our debt and taxes, the actual business of buying and selling houses is getting much closer to breaking even.
Which is true. The operational efficiency is starting to overpower the drag of the old, stale inventory. But this rapid scaling introduces a new massive vulnerability.
Oh.
Yeah, as they buy 5,000 new houses to fuel future revenue, the total inventory burden on their balance sheet is just ballooning. At period end, they were holding 3,420 units.
And depending on which metric in the source material you isolate, that real estate inventory is valued at $1.139 billion on the balance sheet.
Yeah.
With another slide projecting total inventory scaling up to $2.362 billion.
Yeah.
Either way you slice it, that is an ocean of capital tied up in physical driveways and front doors.
It is. They are accumulating fresh inventory at a breakneck pace, which is really the only way to drive future revenue. But buying 3,400 physical houses requires an immense, immediate deployment of cash.
Which brings us to the friction point that really matters.
Yeah.
We need to follow the cash and investigate these adjustments.
Yes.
Because, let's be honest, adjusted margins are great for a PowerPoint presentation, but they don't pay the bills.
Yeah.
You can adjust your numbers all day long, but you can't pay a roofing contractor in adjusted EBITDA.
No, you absolutely cannot. Profitability metrics and actual cash flow are two entirely different languages in corporate finance, and relying purely on one is incredibly dangerous.
Well, here's where it gets really interesting. If we look at the fine print of the cash flows, we see some massive adjustment items reconciling that net loss to the actual cash in the bank.
Yeah.
For instance, there is a gargantuan jump in stock-based compensation. It went from just $14 million in Q1 of 2025 to $120 million in Q1 of 2026.
That's a huge leap.
Right. My question is, are these adjusted non-GAAP numbers just hiding the real cost of running the machine?
Yeah.
If you are paying your executives or engineers $120 million in stock instead of a cash salary, that is a very real expense. It dilutes you, assuming you are a shareholder.
If we connect this to the bigger picture, it highlights exactly why sophisticated investors demand to see the cash flow statement.
Yeah.
Non-GAAP numbers like adjusted EBITDA, they are designed by management to show the core operational performance. They argue that issuing stock doesn't drain the bank account today, so it shouldn't count against their operational efficiency metric.
But it's still a cost.
Exactly. You are entirely correct. Dilution is a severe cost to the owners of the business.
And the stock-based compensation isn't even the wildest adjustment hiding in these documents. Let's talk about that billion-dollar loss from the prior quarter.
Yes. The Q4 2025 numbers were heavily distorted by another massive non-operating item, a $933 million gain on the extinguishment of debt.
Okay, we definitely need an ELI 5 on extinguishment of debt. How do you post a billion-dollar net loss while simultaneously claiming a $933 million gain?
It sounds absurd, but imagine you owe a bank $1,000. You promise to pay them back over 10 years. But suddenly, interest rates skyrocket, and the bank is desperate for liquidity today.
Okay, I'm with you.
So the bank calls you up and says, look, if you give us $800 right now in cash, we will forgive the entire $1,000 loan. You take the deal. On your accounting spreadsheet, you just made a $200 profit because a debt vanished.
Oh, wow.
But in physical reality, your checking account just dropped by $800.
Ah, so you recognized a massive gain on paper, but you actually drained your physical cash reserves to do it.
Exactly that. Opendoor retired huge tranches of their debt at a discount, creating nearly $1 billion in paper profit. It completely warped their net income metrics.
That makes so much sense now.
This is why we have to ignore the accounting turbulence and look strictly at the raw cash. And the cash flow reality paints a very sobering picture of a tightening financial vice.
Walk us through the actual bank account, because if they are buying 5,000 houses, that cash is, it's flying out the door.
It is. First, looking at the day-to-day operations, they burned through $246 million in cash in Q1 2026 alone.
So even with the improved margins and the fast-selling inventory, keeping the lights on and the properties moving, drained $250 million in just 3 months.
Yes. But the second factor is much more critical. Their primary funding strategy seems to be hitting a wall or intentionally shifting. Companies like this rely on something called non-recourse asset-backed debt to buy houses.
Okay.
In Q1 2025, proceeds from this debt were $576 million. But in Q1 2026, those proceeds plummeted to just $68 million.
That is an unbelievable drop. But wait, what exactly is the non-recourse mechanism? Why is that specific type of debt so crucial to their survival?
Non-recourse debt is essentially a protective firewall for the company. When Opendoor borrows money to buy a batch of houses, the debt is tied exclusively to those specific physical properties.
Right.
If the housing market suddenly crashes and Opendoor defaults on that loan, the bank is legally only allowed to repossess those specific houses.
Oh, I see.
Yeah, the bank has, quote, no recourse to go after Opendoor's corporate checking account. It completely ring-fences the risk.
So it's incredibly safe for the company, but incredibly risky for the lender, which explains why a drop from 576 million down to 68 million is a glaring red flag.
Huge red flag.
Either the lenders are looking at the volatile real estate market and refusing to offer those protective terms anymore, or Opendoor is being forced to use its own raw cash to fund acquisitions.
And both scenarios put immense pressure on the balance sheet. And we see the result flowing directly down to the bottom line. Total cash reserves dropped about $234 million in the quarter, leaving an ending balance of $1.067 billion.
That's a steep drop.
Yeah. Furthermore, shareholders' equity declined by $111 million down to $954 million, despite the fact that their outstanding shares actually dropped.
Let's pause and synthesize this, because these two intersecting lines are dramatic. On one hand, the physical algorithm is operating better than it has in years.
Right.
They are pricing homes perfectly, clearing out aged inventory down to 10%, and achieving strong gross margins on their newest purchases. But on the other hand, to achieve that velocity, they're burning $250 million a quarter, their protective debt proceeds have vanished, and the headline accounting metrics are totally clouded by massive stock payouts and complex debt retirements.
Exactly. The operational engine is undeniably humming, but the fuel tank, the cash, is visibly draining.
Which forces us to ask about the horizon. Do they run out of cash before the physical efficiency can save the balance sheet? What does the outlook for Q2 2026 tell us about where these two lines cross?
Well, management believes Q2 is the moment the lines finally cross into positive territory. They provided an outlook expecting revenue to grow by approximately 25% quarter over quarter.
Well,
They also target contribution margins to hit the middle of their 5 to 7% range.
a 25% revenue bump is strong, but how does that close the massive cash burn we just talked about?
It comes down to their final major projection. Adjusted EBITDA is expected to finally hit break even. And the mechanism allowing them to close that profitability gap so quickly without doubling or tripling their revenue is operating leverage.
Operating leverage.
Right.
How are they deploying that in a business that is inherently tied to physical local properties?
While everyone has been focused on the fluctuating costs of the houses themselves, Opendoor spent the last year ruthlessly gutting its own corporate overhead.
Oh, really?
Yeah, they have automated everything they possibly can. Total operating expenses, so that's the corporate machinery, the tech development, the administrative overhead. All of it has been trimmed from historical highs of $231 million down to $155 million.
Wow, that is a massive corporate diet.
And if you look specifically at their fixed operating expenses in Q1 2026, they dropped to just $33 million. That's a $2 million decrease sequentially and a $6 million decrease year over year.
This makes perfect sense now. If your fixed costs are pinned to just $33 million, but you scale up your physical acquisitions by 45% and project 25% more revenue, you don't need to hire a new software engineer or underwriter for every new house you buy.
Exactly.
The software is already built. Every new dollar of gross profit from those houses falls much faster to the bottom line. They have shrunk the corporate machinery down to a size where the new, highly efficient cohorts of homes can actually power it, rather than being crushed by the weight of it.
It's the ultimate test of their technology. Can the algorithm manage high-velocity real estate volume without requiring a massive human workforce?
Right.
Q2 is when they expect to prove that the answer is yes.
So we've covered the lightning-fast inventory, the hidden accounting turbulence, the non-recourse debt drop, and the hope of operating leverage. Why does this matter to you listening to this right now? Why should you care about Opendoor's earnings if you aren't actively buying or selling a home? You should care because this entire report is a masterclass in reading beyond the headlines.
It forces you to separate the physical reality of a business from the accounting representation of a business.
It's a perfect case study in financial literacy. It proves that headline numbers, like a net loss or an adjusted profit, rarely tell the whole story.
Seldom do.
Right. If you only looked at the year-over-year revenue drop, you'd think the company was in a death spiral. If you only looked at the adjusted EBITDA, you'd completely miss the $120 million in stock dilution. You have to look at the physical velocity of the inventory, the actual cash flowing out of the bank, and the specific mechanics of their debt to find the truth.
This raises an important question, though. When you synthesize all of this data, the algorithms, the high-speed acquisitions, the ruthless culling of aged inventory, what kind of company are we actually analyzing?
So what does this all mean?
Consider this final thought. Opendoor utilized millions of data points to reduce its age inventory to 10% in a quarter, where traditional real estate agents and human sellers were stubbornly stuck at 33%.
Yeah.
They are reacting to market friction and adjusting prices 3 times faster than a normal human transaction. If a company can offload physical real estate that quickly, utilizing complex ring-fenced debt structures, taking strategic paper losses on debt to restructure their balance sheet, all while scaling transactions 45% in a single quarter, are we actually looking at a real estate company anymore?
Wow.
Or is this an algorithmic trading firm that just happens to trade houses instead of stocks?
Now that is a thought that changes the whole perspective. We opened this deep dive looking for simple math. We wanted a clear scoreboard telling us if the company was winning or losing. Instead, we found a high-frequency trading algorithm operating in the physical analog world of driveways and front doors, leaving a trail of incredibly complex financial mechanics in its wake. It's not a simple scoreboard, but hopefully after unpacking the reality of those numbers, the mystery is a little less locked. Keep questioning the headlines, keep looking for the friction, and thank you for joining us on this deep dive. We'll see you next time.